So I just said beforehand, usually the interest rate here cannot drop below the cash rate minus 25%. And you would think interest rates are always positive too. But currently we are living in interesting times. Look at this one here. Central bank enters the unknown with sub-zero rates. Here. So we have inflation rates. Inflation rates are already very low. In some countries, even negative. So Switzerland, for example, has negative inflation rates. And now they have, on top of that, also very, very low interest rates. But remember the formula that I gave you beforehand. So the real interest rate is the nominal interest rate minus inflation rate. So let's say if the Bank of Switzerland dropped its deposit rate to minus 0.75%, and in Sweden minus 25 basis points. So here we have negative nominal interest rates in Switzerland. But remember the formula is real interest rate equals nominal interest rate, so minus 75 basis points, minus inflation. And in Switzerland the inflation was negative 2%, so minus 2% is basically plus 2%, so we have 0.75 negative plus 2%, so the real interest rate in Switzerland is actually still positive at 1.25%. So that's one way we can explain why the interest rates are very, very low and partially negative, is because some countries have deflation. And therefore, in the economy, the real interest rate is a really important one. So with that formula, we can see, well, if we have negative inflation, if we have deflation, but we still want to have low real interest rates, we must have negative nominal interest rates. Still very, very unusual times. So this is actually pretty much brand new. That never happened before. And here, some central bank interest rates also in the negative. That means if the banks hold ESF funds at the central bank, they don't earn money on it, they have to pay additional interest rate to just keep the liquidity at the central bank. And they still do that. So we're living in very, very unusual times. That never happened before in history. And so some economists freak out about it. Some are more calm about it. I personally haven't made up my mind, but I do know it's quite unusual. So we'll see what will happen. Even some government bond rates are negative too. I think we had that in week 1 or 2. So we're living at times with very, very low interest rates. Just here again a little bit of an emphasis. So in lots of textbooks you see they focus a lot on the quantity of money, but actually nowadays central bankers do look at inflation directly. They don't look that much at the quantity of money. I grade this one out here. So if you go into more detail, in future classes I know do this one, there's random fluctuations in ESF2 simply because the RBA is a banker to the Commonwealth government. So the Commonwealth government can decide what they do with the ESF, and that can cause ESF fluctuation. For this class here, I think you've got enough other stuff on your plate, so we just skip that part. Right? It's just to be consistent with other classes. Let's look at this one. How good is the RBA at really targeting or hitting the target for the inflation rate? Remember, they want to target between 2 and 3% of the inflation rate. So in the past here, well, this time it was not published that they want to get 2 or 3%, not so good. So look at this, 16% inflation. So usually, well, it's not hyperinflation like in Zimbabwe, but 16% is too much. So we want to be in single digit. Developed country usually want to have, I reckon, like 2-3%, just like here. 3-4% is still all acceptable, right? But when it's getting above 5%, people start looking a little bit funny. It's for a developed country, you shouldn't have higher inflation rates. So that didn't really look very good. And they published the inflation target, changed their policy a little bit, and we can see since then, much, much better. Monetary policy. So we already explained monetary policy has to do with overnight nominal interest rates between banks. That's the cash rate. And that's the main thing that we see in the news. That's the main thing that the RBA can affect via the repos, via the open market operation, via buying and selling of bonds, or repurchasement agreement of bonds. The one single night interest rate between banks. And it's nominal. But we know that in the economy, economic activity is affected by real variables. So how much does something really cost? How much is the real interest rate? That's important to you. If you're paying on your mortgage 2% interest, sounds very cheap, but house prices are falling by 10%, and all other prices in the economy are falling by 10% too, it means that your real interest rate is 8%. And you can tell, if house prices are going down, all prices are going down, are you willing to get a mortgage at 2% and buy a house if you know that the house price is falling by 10% each year? Most likely not. So that's a simple example of the real variables are the important ones for us to make decisions. Similar for companies. How much real profits, how much the real return is important for a company. And a company is not that interested how much do banks pay each other overnight for a single night. A company would be interested how much does it cost it if I'm getting a 20-year loan to build up a new production plant, to come up with a new idea. The one-night interest rate is not that interesting. It's much more interesting how much it costs me to borrow for decades. So the question is, if we make real decisions based on long-term real interest rates, why is monetary policy affected at all? Why are we interested in monetary policy? There must be some kind of link between the overnight short-term rate and the long-term real rate. And these links to our real actions are so-called monetary transmission channels. Sounds very technical, and you can spend whole semesters just on a single channel, spend in advanced macrocast lots of time on it. We just scratch the surface here. So I grayed some of them out that I don't want to talk about in this class. Some of them I want to talk about a little bit. So there's the traditional interest rate effect. So first of all, monetary policy is affecting short-term nominal rates. But now we can take it one step further. Remember the yield curve, where we have on the one end the short-term interest rate and on the other end the long-term interest rate. And they're all somewhat connected, because the long end is basically the average of lots of short interest rates plus a liquidity premium. If you have a dim memory, that's good enough. The point is they were connected like a chain. So if the RBA is playing here with the short end, the long end is moving a little bit too. So here we have a connection between short-term interest rate and long-term interest rates. And on top of that, inflation expectations of people don't change quickly. So if I ask a business owner now, what do you guess what inflation rates will be for the next 5 years? Most likely they have something in their mind and think like, 2 to 3%, maybe 4%. Currently maybe rather 2%, but I think they wouldn't guess 16%. So people basically take the inflation that they've seen in the past as given. That means that inflation expectations are somewhat constant. So if I'm now having constant inflation expectation, I can change around the equation that I had beforehand. So remember, we want to talk about a link, how we can link nominal short-term interest rates to real long-term interest rates. So the first step we had already is via the yield curve. So we had here time to maturity. And here we had the yield. We know if we crank up this one here, the long end goes up a little bit too. Or if we put it down, usually the long one goes down a little bit too. Right? So we can affect these a little bit. So we have already linked now from nominal short-term to nominal long-term. And now we need from nominal to real. So we have the equation here. It's also called Fisher equation. Interest rate real was interest rate nominal minus the inflation rate, and we can write here expected inflation rate. And I'm just claiming now people have a pretty set expectation of inflation rates. In Australia it would be like between 2 and 4% most people expect. Let's say the RBA is cranking up the nominal short-term interest rate. That means the nominal long-term interest rate is going up too. Since the expected inflation is somewhat constant, it straight feeds through the expected real rates. But only if expected inflation is somewhat constant. And this links up nicely to what we discussed in the beginning of the class. Remember how we discussed in the beginning of the class? It's very important that the reserve banks, the central banks, are independent and that they keep the currency somewhat stable. So this link doesn't work if a central bank is doing all kinds of crazy policies where they're printing lots and lots of money or take money out and where inflation is going all over the place. Then people don't have constant expectations. But if the central banks do a good job, like in Australia, inflation has been somewhat constant. People take it for granted, and then central banks have the power to affect the real interest rate. If you get the general gist, that's good enough. So the link is nominal short-term to nominal long-term via the yield curve, and then for nominal long-term to real via constant inflation expectations. So now we affected the real interest rate, and of course the real interest rate is affecting all our decisions. Via the exchange rate, if the RBA, for example, is increasing the interest rate, so if people are expecting the RBA to increase the interest rate, let's say that's really true, the RBA is cranking up the interest rate, so the interest rate level via the yield curve in Australia is going up. That means more or less people want to invest in Australia now from the world. If the return in Australia goes up, Australia becomes more attractive to international investors, so they need to buy which type of dollars? If you're an American and you want to invest in Australia, you have to buy Australian dollars. If lots of people are buying Australian dollars, the exchange rate is going to appreciate. So that means the Australian dollar basically becomes more expensive, so it has an impact on the exchange rate, and you can imagine that has an impact on our exports. So in this case, if the Australian dollar is appreciating, we're becoming cheaper or more expensive for the rest of the world. More expensive, and therefore exports up or down? Down. We made a link now. The RBA is increasing the overnight interest rates, and via a chain of events that will cause exports to decrease and therefore the economy to cool down a bit. Wealth effect. Remember, in the first half of our class we talked about stock prices, and we talked about how we can calculate how much we should pay for shares, share prices. Basically, share prices can be calculated by anticipating how much dividends there will be in the future and discounting them. And we can discount, of course, with interest rates. So if the RBA is cranking up the interest rates, the discount rate is getting bigger, and therefore the net present value smaller, right? Because the discount rate is under the fraction. So stronger discounting means smaller net present value, means share prices should go down. Now imagine that you have all your saving in shares, and you see yesterday you were worth $50,000, today only $40,000 because all the share price went down. What's happening to your Christmas shopping? More or less. Less, because you feel poorer. That's the so-called wealth effect, so you don't feel that wealthy anymore. And you can do it not only for share prices, you can do it, of course, with house prices, bond prices, everything. Actually, bond price is even better. Interest rates up, bond price straight down. Again, via the yield curve. If you have all your savings in bond prices, you've lost a lot due to interest rate risk. So less Christmas presents. So what else do you have here? Bank lending channel. So this is maybe something that you haven't learned in macroeconomics. Again, I go with interest rates up. That means the RBA is pushing additional money into the market or out if they want to have higher interest rates. So in order to get interest rates up, we need to have bond prices down. And if I'm the RBA and I want to get bond prices down, what should I do with bonds? Buy lots or sell lots? Sell lots. So if I'm selling lots of bonds as an RBA, I get in return. If I give you the bond, you give me ESF. Basically, I take money out of the economy. Fits nicely together again. Interest rates up, money out of the economy. Now, so I'm going to think of a bank balance sheet here. Let's imagine a typical bank. Right, so they have here a bank. They've got lots of stuff, deposits, equity, and they've got here the ESF, and bonds and loans. Now, banks are always worried about two things: liquidity, solvency. These are the two big things in our class, and of course profitability, but in terms of risk, liquidity and solvency. So if this bank here, they give away their ESF, in order to buy more bonds. So this one is minus, this one is plus from the RBA. So the RBA, this example here, minus bonds. And ESF, very careful for the RBA, the ESF is not an asset, but always a liability. So the ESF liabilities go down too. So we have now less ESF in the banking system, less ESF in the economy. If somebody now goes to this bank and says, listen, I want to get a loan, with less ESF available at this bank, is this bank more willing to give a loan or less willing? Less willing, and why? If I create a new loan, let's say they would do it, plus 100. What else do I have to do plus 100 if I make a new loan? Deposits. And remember liquidity. We want to have a certain ratio of deposits to ESF. If you have less ESF, we are not very keen to get more and more deposits, because then we increase the risk of illiquidity. So there's a good chance here that if ESF goes down, we don't want to give out new loans. In fact, we wish to get deposits down a little bit too. So if somebody repays their loan, we simply don't give somebody else a new one, and therefore deposits come down too. Or if you remember macroeconomics, in macroeconomics they talked about the money multiplier. So they basically assume a fixed ratio between ESF and deposits. So if ESF goes down, automatically deposits go down. We in this class don't assume a fixed ratio because we talked about liquidity management. Depending on how the interest rates are and how much risk the bank wants to have, they might have more or less. But in general, that's the idea of this transmission channel here, that if the central bank takes ESF out of the system, banks don't want to have that many deposits, and therefore they give out less bank loans, and therefore there will be less investment and residential activity. So transmission mechanisms here, you can see there's lots of different possible explanations why the nominal short-term interest rates is affecting our real actions. Either here because we feel richer or poorer, either because it's easier or harder to get a bank loan, also the pricing of the bank loan might change, or because exports and imports might change due to the foreign exchange rate, or directly because the bond market interest rates for corporate bonds also changes. There's a million different explanations. Most of them work at the same time. Some of them work stronger at certain times and weaker at other times. So really depending on the situation, it makes more sense to focus on one channel or the other. If you understand the basic idea of that one, that's easy enough here for this class. You don't need to go too much into the nitty-gritty. That was the theoretical story, just looking at the practical story. So here we've got short-term interest rates. The black one is the cash rate. And then we've got the 3 months interest rate here, and we've got a half-year interest rate here. And what you can see here is they're very, very close together. And they're not close together because the RBA is simply copying everything that happens in the 3 months and 6 months market, but they're very close because the 3 months and 6 month market, via the yield curve, is sticking very closely to the cash rate. So you can see in real life, actually the RBA can affect medium-term interest rates. So the same thing would hold a little bit weaker true for longer-term interest rates as well. The real cash rate, remember that I said inflation expectation, and inflation must be somewhat constant for the nominal interest rate to feed through the real interest rate. That's what we can see here too. So if the nominal interest rates go up, usually the real interest rates go up. If the nominal one goes down, the real one goes down. Because inflation, which is the difference between the two in Australia, pretty constant. Not 100%, but somewhat constant. More empirical data. So we've got here again the cash rate, very short term. And here we've got interest rates on loans for mortgages, owner-occupiers. And we can see again, strong correlation. Not 1 for 1, but a lot. So if the RBA is cranking up interest rates, there's usually upwards pressure on mortgage interest rates too. If it's going down, it's going down too. Not 1 for 1, because banks always can make asset and liability management. Right? There's no law that it has to be the same. Variable rates for businesses, basically the story is everywhere the same. So via different interactions of the yield curve and risk structures, if the RBA is changing cash rate, it feeds through all kinds of other interest rates. Nominal, real, short-term, long-term, and therefore affects our actions. Worldwide, the same story holds true. Every country has their own central bank, and what we can see here too is worldwide interest rates used to be much higher, and they took a sudden plonk here in 2008. Remember the movies that you saw, the global financial crisis? It's called Global for a reason. So it might have started and have its source in the US, but it really spread around the world. And therefore, central banks all around the world now were in a rush to help out their banking system. And one way to help out is give plenty of liquidity. Give cheap overnight liquidity so we don't get into any illiquidity troubles for the banks. And that's what banks worldwide did. And the interesting part here is, even though there's a long time ago now, almost 10 years, interest rate remained low. They didn't creep up since then. So these are developed countries. Even for the developing countries or middle-income countries, same kind of story. In the global financial crisis, all of them had to decrease the interest rates and help their banks. Fiscal policy, remember, fiscal policy is not really the topic of this class, but fiscal policy has been very expansionary. That means due to the crisis, the government really tried to get the economy going by having additional spending programs. So in Australia, we had the Pink Bag programs and I think Renew of Schools programs. So they spent a lot of money. And of course, during a crisis, you don't want to increase tax. So the governments loaded up a lot of debt. They borrowed a lot of money from everywhere. In the end, they borrowed so much money that they had trouble to support the economy any further, and therefore asked the central banks to do more. Again, the central banks are independent, but the central banks basically jumped in and helped more. And this led to so-called unconventional monetary policy, not in Australia, but US, Japan, Britain, and Europe, so-called quantitative easing. So number one, in Australia, they say we don't need quantitative easing. This is the treasurer. The treasurer is part of the government. He actually should not really talk that much about monetary policy because the central bank is independent. And it's very important that it's independent. There is a saying, central bankers are like whipped cream. The more you beat them, the harder they get. Now what does that mean? Let's say the central bank thinks we don't need quantitative easing. And now the politicians come out and say, you shouldn't do quantitative easing. If you want to prove that you're independent of the politician, what might happen? You might do the exact opposite. Or even more standard of an example is that if the economy is not doing very well, some politicians then come and say, the central bank should decrease the interest rate. And maybe the central bank was thinking too, yeah, maybe it's a reasonable thing to decrease the interest rate. But if we do it one day after the politicians ask for it, we look less independent. So they might hold back. So it's not a good idea, at least in my opinion, and lots of economists think so too, as a politician to talk about monetary policy. In fact, you can hear I'm coming from Germany. So in Germany, it's considered very, very bad manners for politicians to talk about central banking at all. So they better keep their zip, and then everything works fine. Because you don't want to undermine their independence, and you don't also want to make them upset that they have to prove by being extra tough on you that they are independent. But after that side story, let's come back to quantitative easing. What's the special thing about quantitative easing? Basically, quantitative easing is buying bonds. But you might think, well, we had that with monetary policy before and too. We're just buying and selling bonds. We do repos. That's quite normal. What's different with quantitative easing is two things. Number one, usually the RBA bought bonds with their repos, for example, overnight. They did repos. They say, okay, I buy the bonds now. I'll buy them back tomorrow. So for very short periods of time, they put liquidity in. Number two, what type of bonds? Usually government bonds. Very safe. But during the financial crisis, they kind of ran out of government bonds. It was very tight. And they still wanted to help more and more and more and more. So what they did is two things. Number one, they started buying more different kind of bonds. They accepted also for their repo more different bonds. Corporate bonds, subprime mortgage bonds, MBS, all kinds of stuff all of a sudden was included. And that is true for the US. They made special laws for that one. For Europe and also to a certain degree for Australia. So all of a sudden they bought much more different kind of bonds. They also bought much more bonds than beforehand. So the amount of dealing that the central banks did in the world went just up hugely. And then there's something else. Remember the yield curve? We had the story with the yield curve is you can affect the long-term rates by playing around with the short-term rates. But now the problem was the short-term rates is close to zero. At least in the US it was even actually zero. And getting into the negative territory, we saw in the newspaper article now is possible, but at the time people were too afraid to get into the negative territory. So if your short-term yield is already zero, but you still want to get the economy going, that there is more economic activity. So basically you want to affect the long-term yield. What could you do as a central bank? Instead of buying short-term bonds, you could buy long-term bonds. If you buy lots of long-term bonds, the price of long-term bonds goes up and the yield starts coming down. So you flatten the yield curve. That was also called Operation Twist, partially, because actually they even did the opposite on the short-end side. So they went the short-end side a little bit up again. But by buying long-term bonds, you get the long end of the yield curve down. You decrease the long-term interest rate. And that was a new thing. They never did that beforehand. Beforehand, monetary policy was always via short-term interest rate, short-term bonds. Now, all of a sudden, long-term ones. And that's what they call quantitative easing. So you can see, hopefully, in principle, it's the same thing, but you're targeting another part of the market. So, what did we learn today? Number one, we didn't really learn that in class. You had that beforehand, but I want to emphasize it again. Don't mix up monetary policy with fiscal policy. The two are separate, never to be mixed up as an economist. If we talk about the RBA or central banks, we talk about monetary policy, not fiscal. Always look monetary policy. In Australia, our objective is to keep inflation low at 2 to 3%. The other one's secondary. And the RBA can affect the cash rate. Remember, we've got that channel system with the top one is the repo. The bottom one was the, I think, liquidity facility, or how much you get paid on your ESF holdings. And we can affect the cash rate in between via open market operations and repos. So open market operations is outright buying and selling. Repos is that special contract where you flip it around short term later. Good. So thank you very much for your attention. Next few weeks, I'll look at current topics. If you have something that you're very, very interested in, just drop me an email. And I will create more and more newspaper articles, and we talk about what's happening in the Australian economy and basically apply all the stuff that we've learned in class already.